Gold and silver are rising, and depending on who you listen to, there are very confident explanations for why. Some people say it's because markets are about to crack. Others say it's simply because gold and silver were held artificially low for years and are now catching up to where they should already be. Welcome to Money and Power. If you value calm, clear analysis of money, debt, and the forces shaping the global system, you may want to subscribe. I post regularly, and this channel is about understanding, not hype. And both of those explanations sound convincing. But they also miss something important. Because if gold and silver were rising for the reasons most people think, the behaviour around them would look very different. There would be more noise, more urgency, more fear, more attention. Instead, what we're seeing is something much quieter. Markets still feel calm. Rates are being cut. Forecasts are improving. Most people aren't talking about precious metals at all. And that contradiction matters. Let's start with the idea that metals rise when people panic. Historically, that's true. But panic-driven moves have a very specific feel. They're fast, they're emotional, they're accompanied by headlines and volatility. That's not what this looks like. Gold and silver have been moving higher, while confidence remains broadly intact. There's no sense of emergency, no rush into safety, no widespread fear. So if this isn't panic, what is it? Then there's the second explanation. The one many long-time metal holders prefer. The idea that gold and silver have been structurally undervalued, that their prices have been suppressed, and that what we're seeing now is simply a long overdue catch-up. There's truth in that argument. If you look at debt levels, monetary expansion, and the scale of obligations sitting behind the system, it's not difficult to build models where gold and silver prices look far higher than where they trade today. The US debt clock is often cited here, showing theoretical prices that imply gold and silver are still dramatically undervalued relative to debt. But those figures are not market prices, they're models. They assume structural changes that haven't happened yet. They assume resets, re-anchoring, or full repricing of confidence. Markets don't jump to theoretical value overnight. They move according to trust. And trust rarely breaks suddenly. It erodes gradually. That's the part both sides tend to miss. Gold and silver don't need fear to rise, and they don't need a formal reset either. They rise quietly when confidence starts being hedged rather than expressed. That's a very different signal. What we're seeing looks less like panic and more like positioning, less like speculation and more like quiet adjustment. As I'm recording this just before markets have reopened fully, gold is trading around $4,342 an ounce, and silver is elevated as well at around $67 an ounce. And yet, there's no sense of drama about it. That alone should make people pause. Because when markets genuinely believe something is broken, the reaction is never this calm. Instead, what appears to be happening is that long-term holders are slowly rebalancing. Institutions are diversifying without urgency. Confidence is being diluted, not abandoned. And that fits exactly with what we've been discussing. Rates are being cut, not because everything is fixed, but because the system cannot tolerate the current load. Debt isn't being reduced, it's being managed. Pressure isn't being released, it's being absorbed. In that environment, precious metals don't surge because people are scared. They rise because trust is being hedged quietly. That's why, the usual narratives don't quite fit. If this were a collapse story, metals would be exploding. If this were just a catch-up story, the move would be sharper and louder. What we're seeing instead is slow repricing during calm. And that's actually far more significant, because it tells you the system is still functioning, but it's doing so under increasing constraint. This is also why precious metals tend to move before narratives change. By the time fear becomes obvious, the repositioning has already happened. By the time headlines shift, the quiet decisions are already behind us. Gold and silver don't lead because they predict disaster. They lead because they respond to confidence long before confidence becomes a talking point. That's why framing this as either panic or suppression misses the bigger picture. The more accurate explanation is simpler and less dramatic. Confidence isn't collapsing, but it's no longer being taken for granted. And that's enough. So when people say gold and silver are rising for the wrong reasons, the irony is this: they're rising precisely because the reasons don't feel obvious yet. They're moving in an environment where everything still looks manageable, where markets still behave, where forecasts still sound reassuring. And historically, that's when the most important shifts begin. Not loudly, not suddenly, but quietly, while most people are still debating the wrong explanation. Now, if you like this video, please give it a thumbs up. For more commentary, subscribe to the channel and press the bell sign so you're notified of our videos as and when they are published. And in addition, a quick shout out to the 2 videos that we have produced already this past weekend. Please do not miss them, because frankly, the 3 videos together, that produced on Friday, Saturday and Sunday, or depending where you live, Saturday, Sunday and Monday, are a trilogy for the forthcoming 2026. They are entitled "The Debt Storm is Breaking, 5 Red Flags You Cannot Ignore in 2026, and Why the Real Warning Signs Never Feel Dangerous." And I've placed links to both of these in the description box below. Thank you once again, and I look forward to seeing you in our next video.